Welcome back. Well, it is Fed meeting day today and tomorrow. All eyes on the Federal Reserve. We're watching to see what comes out of that two-day meeting and whether or not it will result in an interest rate increase tomorrow. The Fed widely expected to announce it will raise rates by 1/4 point tomorrow. Joining us right now to talk more about it is Wells Fargo Investment Institute Senior Global Equity Strategist Scott Wren. And Scott, it is good to see you. Thanks so much for joining us.
Good morning, Maria.
Is it not snowing where you are?
Yeah, it is. Yesterday we had a little bit of snow, a couple of inches, and it's flurries out there right now. But I was really hoping for the end of winter, but it looks like we have one more bout of it anyway.
Yeah, it certainly does from our standpoint here in New York. What do you think about the Fed, Scott? Are you expecting an interest rate increase, and does that change the tenor of this market, which of course has been rallying since Election Day?
Well, Maria, I would have told you 2 months ago that the Fed was not going to hike in March, but then, 4 or 5 weeks ago, they started dropping some hints. So, they're going to raise on Wednesday. They're going to announce tomorrow that the rates are hiked. I mean, our official call has been for 2 hikes this year. We thought they were going to be in June and December, but now, 2, 3 hikes. You see one in March. Maybe they do September and December, but I think the market has fully priced in. What's important is the market is certainly fully priced in this hike that they'll announce tomorrow, and then I would argue also that they've priced in 2, 3 hikes. The market's fine with that.
So in other words, when you say priced in, you don't think the market sells off just because rates are starting to go higher?
I do not, and I think it's all about pace and magnitude. I think the problem would be if Janet Yellen is going to give no indications that they're going to step up this pace. I believe tomorrow. I think the problem would be at let's say the June meeting or September meeting or something. If the Fed started talking about a 12-month forward period where there would be 4 or 5 hikes, that's not priced in.
Sure.
Next year GDP might be 2.5%, something like that. The market's not prepped for any kind of rate hike pace like that, and that would be a problem.
That's a vote of confidence, John Hilsenrath.
I think it is. What I'm trying to get my hands around is, back in 2013, when the Fed hinted that it was going to end its bond buying program, we had a taper tantrum. Markets fell apart, bond yields rose, stock prices fell, emerging markets tanked. This time, the Fed has said it's going from 1 rate hike last year to 3 rate hikes this year. And the market is hitting new highs every day. What's changed? Why is the market comfortable with less easy money today when it was so uncomfortable with it a couple of years ago?
John, I think that this has been a very slow recovery, obviously, but on a calendar year basis, you're right around 2%. I think the market perceives that as pretty dependable. I think we would argue that, if the market's going to grow 2%, our numbers are a touch higher than that this year. Does the Fed funds target rate really need to be 50 to 75 basis points? I don't think so. So, this is a pure normalization move here. The market's going to give the Fed one here. They might as well take advantage of it, and all this year is just more of a normalization type thing. And the last thing they want to try to do is slow the economy down, certainly. But beyond this, in 2018, if we see some wage pressure, which I think we're going to, the market in the second half of this year, I think one headwind is going to be just fears that the Fed is going to feel like they're behind the curve and has to catch up.
Fine.
Scott, we just finished talking about the CBO estimates on the health care plan. I mean, these issues around health care and tax reform are just dominating conversation. What does Yellen have to do to navigate that? Because it seems like that's going to be the bigger issue here as opposed to the 1/4 point rate hike in March.
Yeah, I think, for us, the health care issue, that's going to play out over, I think, a longer period of time, as I think many of these proposals are going to take longer to implement. I think what Janet Yellen needs to do is recognize that this is going to take some time, talk about that, and make sure that the markets know that the Fed is not going to go too fast here. The Fed is not expecting any kind of a surge in economic activity this year or next year, and that the pace is going to be modest, as they've been talking about. So it's more of a kind of massaging the market to let them know that they're not going to try to slow the economy down. They're going to let this play out. They know the proposals are going to take a while to work out.
All right. So what do you tell clients then, Scott? I mean, how do you allocate capital? Financials have been on fire. You want to get on that train? You want to take some money off the table? What are you doing?
Well, we've been overweight financials, and that's worked out well. We're also overweight consumer discretionary and industrials and healthcare. So overall, we've been playing the more cyclical side of these sectors. I think that's still the way to do it. But, Maria, for us, you know, when we released our targets for year-end 2017 last year, we felt that the S&P 500 was going to make its high for the year somewhere around the middle of the year. Our top end of our target range is 2330. We thought it would be at or slightly above that. Here we are. We're slightly above it.
Yeah.
It's a couple of months earlier than what we thought. So I don't think this cycle is coming to an end. But based on our work anyway, by the end of this year, you're going to be in the 2230, 2330 range. You're going to be a little bit lower than where we are now. Net, this is going to be a stall to slightly positive year for stocks. We want our clients invested. You know, we're not expecting a 15% pullback or anything. We don't think the cycle's over. You know, you need to see some of these policy things play out. I think 2018 will be better for the market.
Yeah, it's all about policy at this point. The markets are waiting for it. We're waiting for it. We'll be watching. Scott, good to see you, sir. Thanks so much.
All right. Have a good day, guys.
Stay dry. Scott Wren joining us there.
You too.